Welcome to Iron Financial, the show where we help you forge a stronger portfolio. Today, we're taking a sledgehammer to the financials of Alphabet. We're going to stress test this company from its foundation all the way to the top to figure out if it's a real financial fortress or just an elaborate, expensive facade.
So let's start with a big, shiny number. In Q3 2025, Alphabet didn't just have a good quarter. They blew past a massive milestone, over $100 billion in revenue, in a single quarter. Now that's a number that's built to impress. It grabs headlines, it moves the market, and it absolutely screams strength.
Whoa, hold on a second. A big number is one thing, but it doesn't automatically mean the company's structure is sound. We've seen giants stumble and fall. So we gotta ask, is this $100 billion mansion built on solid bedrock? Or are we just looking at a fresh coat of paint hiding some serious cracks in the walls? Is this for real, or is it just hype?
That's a fair question. You know, every fortress has to have a massive foundation holding everything up. For Alphabet, that has always been its search and advertising business. This is the rebar and forced concrete that supports the entire empire. So let's drill down and see how solid it really is.
Okay, looking at the raw numbers, the story is pretty compelling. The two main pillars here, Google Search and YouTube ads, are growing in lockstep, both up a powerful 15% year over year. That's solid. But you gotta look closer. See that last line? The Google network, that's the ads on other people's websites, it's actually shrinking, down 3%. It might be a small crack, but it is a crack. It tells you this foundation isn't totally immune to pressure.
And for years, the biggest threat to this whole thing, the real wrecking ball hanging over this foundation, has been the threat of antitrust regulation. The fear was that regulators would force them to break up the core business. Exactly. The nightmare scenario was a forced spin-off of something huge, like the Chrome browser. But that threat just kind of vanished. A federal judge handed Google what one analyst literally called a monster win. They get to keep their browser, they get to keep their search deals. This ruling basically shores up that foundation in a huge way. It de-risks the whole operation.
All right, so with that foundation secured, let's look at what they're building on top of it. The next skyscraper they're trying to erect here is Google Cloud. And they're not just using regular steel and glass. They're supercharging it with the single biggest force in tech right now, AI. So for more than a decade, Amazon's AWS was the undisputed king of the cloud. No question. But AI completely changed the battlefield. What's so important about this chart is that it's not showing total market share. It's showing the share of new money coming in, new annual recurring revenue. Microsoft's Azure is leading the pack, sure. But look at Google Cloud. It's now grabbing over a quarter of all the new business, leaving the old champ AWS way behind. AI is the battering ram here, and it is reshaping the entire industry.
And hey, if you want stone-cold proof that this growth is real, look no further than this number. $155 billion. That is the value of contracts Google Cloud has already signed but hasn't even recognized as revenue yet. This isn't just a good quarter. It's a tidal wave of future business that's up a staggering 82% from just last year.
Right, so the takeaway here is that this isn't some fuzzy, maybe someday promise. The company's own CFO, Anand Ishkenazi, laid it out on the earnings call. Their enterprise AI products are already a multi-billion-dollar per quarter business. AI isn't just helping Google Cloud grow. It's already a core financial pillar of the whole operation.
Okay, the core business is solid, the new cloud engine is firing on all cylinders. I get it. But let's talk about the crazy expensive hobbies. Every empire has them. For Alphabet, it's the Other Bets division, this whole portfolio of so-called moonshots. Are these really the blueprints for the future, or are they just a massive cash furnace that threatens to burn the whole structure down?
And this chart really just says it all, doesn't it? I mean, look at where the actual money comes from. Other Bets is so small it's barely even a sliver. It contributes less than 1% of the company's total revenue. From a money-in perspective, these projects are practically invisible.
But they are not invisible when you look at the expenses. In just one quarter, this division brought in a measly $344 million while managing to burn through $1.4 billion in operating losses. That is over $1 billion just gone in 90 days. It is the textbook definition of a high-stakes gamble.
But here's the other side of that coin.
You can't just call it burning cash. It's an investment in technologies that could completely change the world. Waymo's pushing driverless cars into London, Verily is working with NVIDIA, Boston Dynamics is teaming up with DeepMind to build actual brains for humanoid robots, and here's the kicker. Their investment in the AI startup Anthropic, it's already generated an almost $11 billion gain on paper. It's not revenue yet, but it's a massive return. This isn't just an expense line. It's basically a venture capital firm hiding inside Alphabet.
Look, future tech is cool, I get it, but let's bring this back down to earth, back to the present. Building this whole empire, the ads, the cloud, the AI, the crazy moonshots, all of it requires a ton of heavy lifting and just mountains of cold, hard cash. So what's the actual construction cost here?
Well, here's your answer. Management just raised their forecast for capital expenditures, that's money spent on things like servers and data centers, to as much as $93 billion. For this year alone. Just let that sink in for a second. That is the price tag for building the future of AI. It is a staggering amount of money.
And all that heavy spending is creating some very real stress on the structure. Management called out 3 big things, putting pressure on their profit margins. First, all those brand new servers start losing value, or depreciating, which is a big accounting expense. Second, the power bill to run all this stuff is just jaw-dropping. And third, they got slapped with a $3.5 billion fine from the European Commission, which takes a direct bite out of profits. These are the cracks starting to appear in the armor.
Okay, so we've inspected the foundation, we've toured the new towers, we peeked into the secret labs, and we've tallied up all the construction costs. It is time to weigh all the evidence and deliver the final iron financial verdict.
All right, on one side of the scale, you have the undeniable strength of a fortress. You've got clear AI dominance, that accelerating cloud growth, a rock-solid balance sheet, and that monster win against the regulators. But on the other side, you've got those cracks, the massive capital spending, the mounting pressure on margins, and the headwinds we saw in the ads business.
So here's our verdict. This is no facade. The fortress is absolutely real. But it is a fortress that's in the middle of a massive, incredibly expensive, and really noisy construction project. Our final call? This is a heavy-duty opportunity. The structure itself is incredibly strong, but building it even higher is going to require the heavy lifting of massive, ongoing investment.
So the final takeaway is this. Alphabet isn't just patching up its old fortress, it's pouring an entirely new foundation made of AI and cloud to support the next several decades of growth. It's an unbelievably ambitious project, and the potential is undeniable. The only question you have to ask yourself as an investor is this: can your portfolio afford to pay for the construction?
I am not a financial advisor. This is for educational and entertainment purposes. Do your own research.